I need to warn you about something that's happening right now with gold IRAs that could seriously impact your retirement savings. And I'm not talking about some distant future scenario. This is unfolding as we speak, and if you have gold in an IRA, you need to understand what's changed and what it means for you. Let me start with the elephant in the room. Gold just had one of its most explosive years in modern history. We're talking about a nearly 50% surge. That's not normal. That's not just market noise, that's institutional panic buying, disguised as strategic allocation. And while everyone's celebrating their gains, there are critical regulatory changes that just went into effect that could completely alter how you access and pass on that wealth. Here's what most people don't realize. The Secure 2.0 Act fundamentally rewrote the rules for retirement accounts, including gold IRAs. And these aren't minor tweaks. These are structural changes that affect when you must take distributions, how much you must withdraw, and what happens when you pass that account to your heirs. The implications are massive, and most gold IRA holders have no idea these changes even exist. Let's talk about required minimum distributions first, because this is where things get interesting. The age for RMDs just increased to 73. Now, on the surface, that sounds like good news. You get to defer taxes a bit longer, let that gold appreciate without forced withdrawals. But here's the catch that nobody's talking about. When you do start taking those RMDs, you're pulling physical gold out of your account at whatever the market price is at that moment. And with gold trading near all-time highs, that creates a very specific problem. Think about the mechanics for a second. You're required to withdraw a certain dollar amount, but gold is priced in dollars per ounce. So if gold is at $2,600 an ounce when you turn 73, you're withdrawing fewer ounces to meet that dollar requirement. But what happens if gold hits $4,000 or $5,000 an ounce in the next few years? You're still required to take that same percentage out, but now you're liquidating even fewer ounces. The math starts working against you in ways that aren't immediately obvious. And here's where it gets even more complex. Morgan Stanley just came out with a forecast. They're projecting gold at $4,800 per ounce by the fourth quarter of next year. That's not some fringe analyst making wild predictions. That's Morgan Stanley, one of the largest financial institutions in the world. They're looking at the same data we are, the same central bank buying, the same geopolitical tensions, the same monetary policy trajectory, and they're saying gold has another 85% to run from current levels. Now, imagine you're 72 years old right now. You've got a substantial gold IRA. You're 1 year away from mandatory distributions, and gold is about to potentially double. Do you take an early distribution and pay the penalty to lock in more ounces at today's price? Do you wait and hope the price doesn't spike before you're forced to sell? Do you convert some to a Roth and pay taxes now to avoid RMDs entirely? These are the questions that should be keeping gold IRA holders up at night, and most people aren't even asking them. But the RMD changes are just the beginning. The beneficiary rules are where this gets really problematic. Under the old system, if you inherited an IRA, you could stretch those distributions over your lifetime. It was called the Stretch IRA, and it was one of the most powerful wealth transfer tools in existence. You could inherit a gold IRA at 50 years old and take tiny distributions for the next 30 or 40 years, letting that gold compound tax-deferred for decades. That's gone now. Completely eliminated for most beneficiaries. Under Secure 2.0, if you inherit an IRA after 2020, you have 10 years to drain the entire account. 10 years. And here's the part that just went into effect this year. You also have to take annual RMDs during those 10 years if the original owner had already started taking distributions. So you're forced to liquidate gold every single year, whether you want to or not, whether the price is favorable or not, whether it makes sense for your tax situation or not. Let me paint you a picture of what this looks like in practice. Your father passes away. He's got a $500,000 gold IRA. He was 75, so he'd already started RMDs. You inherit it. Under the new rules, you have to start taking annual distributions immediately, and you have to empty the account within 10 years. That means you're pulling out roughly $50,000 a year every year for a decade. And that $50,000 gets added to your ordinary income every single year. Now, if you're in your peak earning years, making $150,000 or $200,000 a year, that inherited IRA just pushed you into a higher tax bracket. You're paying 35% or 37% federal tax on money that your father already paid taxes on when he earned it, and you have no choice. You can't defer it. You can't stretch it. You can't time it for a year when your income is lower. The government just fundamentally changed the deal on generational wealth transfer, and they did it quietly, buried in a 350-page retirement bill that most people never read. But here's where the gold-specific aspect becomes critical. When you're forced to take those distributions, you're not just paying taxes, you're liquidating a hard asset at whatever the spot price is that day. And gold doesn't move in a straight line. It's volatile, it gaps. It can drop $100 in a single session on nothing but a hawkish Fed comment or a strong dollar rally. So you might be forced to sell gold at $2,400 an ounce to meet your RMD, while 6 months later it's back at $2,700. You just gave up $300 per ounce because of a regulatory requirement that didn't exist 3 years ago. And this is happening against a backdrop of the most extraordinary gold market we've seen in decades. Let me give you some context on what's actually driving this price action, because it's not what most people think. Everyone wants to talk about inflation. Everyone wants to talk about the dollar. Those are factors, sure. But the real story is institutional accumulation on a scale we've never witnessed before. Central banks bought over 1,000 tons of gold last year. That's the second highest annual purchase in history. And they're not slowing down. China's been adding to reserves every single month. Poland just announced they're targeting 20% of reserves in gold. India's buying. Turkey's buying. Even countries that traditionally held minimal gold are suddenly building positions. This isn't retail investors buying coins. This is sovereign nations restructuring their reserve assets away from dollars and into physical metal. And here's what makes that significant for gold IRA holders. When central banks buy gold, they're not trading it. They're not flipping it for a quick profit. They're vaulting it permanently. That gold is coming off the market. It's being removed from the available supply. And unlike stocks or bonds, you can't just create more gold with a keystroke. The mining supply is relatively fixed. We pull about 3,000 tons out of the ground every year, and that number hasn't changed much in a decade. So when central banks are absorbing a third of annual production, that's a structural supply deficit that has to resolve through price. But there's another layer to this that most people miss. The gold market isn't just physical metal, it's also paper contracts, futures, ETFs, unallocated accounts. And the ratio of paper gold to physical gold is estimated to be somewhere between 100 to 1 and 250 to 1, depending on who you ask. That means for every ounce of actual metal in a vault somewhere, there are 100 or 200 claims on that same ounce through various financial instruments. Now, as long as everyone's happy holding paper, that system works fine. But the moment people start demanding physical delivery, the whole structure becomes unstable, and that's exactly what we're seeing. ETF inflows have been massive. SPDR Gold Shares, the largest gold ETF, has seen billions in inflows. But more importantly, we're seeing increased delivery requests on COMEX futures contracts. Traders are standing for delivery instead of rolling contracts forward. That's unusual. That suggests people want the actual metal, not just price exposure. And when you combine that physical demand with the regulatory changes forcing gold IRA holders to liquidate, you create a very specific market dynamic. You've got central banks and institutions trying to accumulate physical metal. You've got paper gold holders increasingly wanting to convert to physical. And you've got a new regulatory framework forcing retirement account holders to sell at predetermined intervals regardless of market conditions. That's not a recipe for stable prices. That's a recipe for volatility and potential supply squeezes. Let me give you a historical parallel because we've seen this movie before. In 1971, Nixon closed the gold window, ended dollar convertibility to gold. Gold was $35 an ounce. Within 9 years, it hit $850. That's a 24x return. But here's what most people forget about that run. It wasn't smooth. It wasn't steady. Gold would rally $100, then crash $50. It would consolidate for months, then explode higher in a matter of weeks. The people who made life-changing wealth weren't the ones who tried to trade it. They were the ones who held through the volatility and understood the macro trend. We're in a similar setup now, except the stakes are higher. The dollar isn't backed by gold anymore, but it's also not backed by much of anything except faith in U.S. fiscal responsibility. And with $36 trillion in national debt, deficits running over $1 trillion a year, and no political will to address it, that faith is being tested. Countries are watching. They're diversifying. They're buying gold. And they're doing it quietly, consistently, month after month. Now, if you're sitting on a gold IRA right now, you need to understand something. The rules just changed in ways that could force you to sell at the worst possible times. But there are strategies to navigate this. There are ways to structure your retirement accounts to maintain gold exposure while minimizing the tax impact of these new distribution requirements. And there are specific moves you can make right now before you hit that RMD age that could save you tens of thousands of dollars in taxes over the next decade. Quick aside here, because this is relevant. If you've got $100,000 or more in retirement accounts, and you're trying to figure out how to navigate these new rules while maintaining precious metals exposure, I put together a comprehensive guide on gold IRAs. It's free. It's in the description below. Covers everything from how physical gold works in a retirement account, to strategies for managing RMDs, to beneficiary planning under the new Secure 2.0 rules. Worth checking out if this applies to your situation. All right, back to the market dynamics, because there's another piece of this puzzle that's absolutely critical: the dollar. Everyone talks about gold in dollar terms. Gold's at $2,600. Gold's at $2,700. But that's only half the story. Gold isn't just going up. The dollar is losing purchasing power, and the distinction matters. Think about it this way. If gold goes from $2,000 to $4,000, did gold double? Or did the dollar lose half its value? The answer is both and neither. Gold is simply maintaining its purchasing power, while the currency it's priced in devalues. An ounce of gold bought a nice suit in Roman times. It buys a nice suit today. The dollar bought a nice suit in 1970. Today it buys a decent shirt. That's the difference between money and currency. And right now, we're in the middle of the largest monetary experiment in human history. The Fed printed more money in 2 years than in the previous century combined. They expanded the balance sheet from $4 trillion to $9 trillion. And while they've been trying to unwind that through quantitative tightening, they're barely making a dent. The money supply is still massively elevated, and that money is sloshing around the system, looking for hard assets to preserve purchasing power. Gold is the ultimate hard asset. It's been money for 5,000 years. It's survived every empire, every currency, every financial crisis. And it's doing exactly what it's supposed to do right now. It's preserving wealth while paper currencies devalue. The problem is, most people's gold is locked up in retirement accounts with new rules that force them to liquidate at government-mandated intervals. Let me give you another scenario to think about. It's 5 years from now. Gold is at $5,000 an ounce. You're 75 years old. You're required to take an RMD of $40,000 from your gold IRA. That's 8 ounces of gold. But you don't need the money. You've got Social Security. You've got a pension. You've got other savings. You're taking this distribution purely because the government says you have to. And you're paying 25% federal tax on it, plus state tax, plus you're liquidating an appreciating asset that you'd rather hold. That's the reality of the new rules. And it's not just affecting you, it's affecting everyone who built wealth in gold IRAs over the past 2 decades. Millions of Americans who did the responsible thing, who diversified into hard assets, who protected themselves against currency devaluation, are now facing a regulatory framework that penalizes that exact strategy. But here's what's really interesting. While retail investors are being forced to sell through RMDs, institutions are buying, hedge funds are accumulating, family offices are allocating, sovereign wealth funds are building positions. There's a massive wealth transfer happening right now, and it's flowing from forced sellers to strategic buyers, and most people don't even realize it's happening. The COMEX data tells the story. Commercial traders, the big banks and institutions, have been reducing their short positions. They're covering. They're going long. Meanwhile, speculative traders, the hedge funds and momentum players, are building shorts, betting on a pullback. That's the classic setup for a squeeze. When the commercials are positioned one way and the specs are positioned the other, the commercials usually win. They have better information. They have deeper pockets. And they're not trading on technicals. They're trading on fundamentals. And the fundamentals for gold right now are about as bullish as they've ever been. You've got negative real interest rates when you account for actual inflation. You've got geopolitical tensions at levels we haven't seen since the Cold War. You've got de-dollarization accelerating across the developing world. You've got central banks buying at record pace. You've got supply constraints in physical metal. And you've got a new regulatory framework forcing retirement account holders to become sellers at predetermined intervals. That last point is crucial because it creates predictable selling pressure. The government just mandated that millions of gold IRA holders become forced sellers starting at age 73. That's not organic market action. That's regulatory intervention creating artificial supply. And smart money knows it. They're positioning to absorb that supply at favorable prices, knowing that the underlying demand from central banks and institutions will ultimately overwhelm the forced selling from retail accounts. Now, let's talk about what this means for beneficiaries, because this is where the wealth transfer implications become really stark. Under the old stretch IRA rules, you could pass a gold IRA to your children or grandchildren, and they could take distributions over their lifetime. A 30-year-old inheriting a $500,000 gold IRA could stretch those distributions over 50 years. That's 50 years of tax-deferred growth in a hard asset that historically appreciates over time. Under the new rules, that same 30-year-old has to drain the account in 10 years. And if you'd already started RMDs, they have to take annual distributions during those 10 years. So instead of 50 years of tax-deferred compounding, they get 10 years of forced liquidation. The government just cut the wealth transfer timeline by 80%, and they did it retroactively, applying it to anyone who inherited an IRA after 2020. Think about the tax implications. That 30-year-old is probably in their peak earning years. They're making good money. They're in a high tax bracket. And now they're forced to add $50,000 a year from the inherited IRA to their income. That could easily push them from the 24% bracket to the 32% bracket. They're paying an extra 8% in federal tax on every dollar, plus state tax, plus the loss of various deductions and credits that phase out at higher income levels. The effective tax rate on that inherited IRA could be 40% or more. And remember, that IRA was funded with after-tax dollars. Your father paid income tax on the money he contributed. He paid tax on the gains when he took RMDs. And now his beneficiary is paying tax again on the same money. It's double taxation disguised as retirement policy. And it's specifically targeting wealth transfer through retirement accounts. But here's where the gold component becomes a potential advantage if you structure it correctly. Gold is a hard asset. It's portable. It's divisible. It's liquid. And unlike stocks or bonds, it exists outside the financial system. If you take physical delivery of gold from an IRA, you're converting a paper asset into a tangible one. You're moving wealth from the regulated financial system into your direct possession. Now, I'm not suggesting anything illegal. You still have to pay taxes on distributions. You still have to follow the rules. But there's a strategic element to timing those distributions and deciding what form they take. Do you take cash and buy gold outside the IRA? Do you take physical delivery and vault it yourself? Do you convert to a Roth and pay taxes now to avoid future RMDs? These are complex decisions that depend on your specific situation, but they're decisions that every gold IRA holder needs to be thinking about right now. And the urgency is real. Because we're not just talking about regulatory changes. We're talking about a market that's fundamentally shifting. Gold just broke out to new all-time highs. It's holding those highs. And the technical setup suggests we're in the early stages of a major bull run, not the end of one. When Morgan Stanley is forecasting $4,800 gold, when JP Morgan is talking about continued central bank buying, when the World Gold Council is reporting record demand, you're not looking at a market that's about to reverse. You're looking at a market that's repricing based on new fundamentals. And those fundamentals include a regulatory environment that's increasingly hostile to retirement account wealth transfer. The government needs revenue. They've got massive deficits. They've got entitlement programs that are underfunded. And they're looking at trillions of dollars sitting in IRAs that have never been taxed. The Secure Act and Secure 2.0 are the opening moves in what's likely to be a long-term effort to accelerate taxation of retirement accounts. Think about the incentives. The government wants you to take distributions. They want you to pay taxes. They want to convert that tax-deferred wealth into current revenue. And they're willing to change the rules to make it happen. The stretch IRA is gone. RMD ages are being adjusted. Beneficiary rules are being tightened. This is a trend, not an isolated change. And if you're holding significant wealth in a gold IRA, you need to be thinking several moves ahead. Here's another angle that most people miss. Gold IRAs are custodial accounts. You don't actually possess the gold. It's held by a custodian on your behalf. And while that's fine under normal circumstances, it creates a specific vulnerability. You're dependent on that custodian's solvency, their security, their compliance with regulations. If something goes wrong, if there's a bankruptcy, if there's a regulatory change that affects custodial requirements, your gold is caught in that system. Now, I'm not saying custodians are going to fail. Most are well capitalized and properly insured. But I am saying there's counterparty risk that doesn't exist when you hold physical gold directly. And in a world where financial institutions are increasingly fragile, where bank failures are becoming more common, where regulatory uncertainty is the norm, that counterparty risk is worth considering. This is why some sophisticated investors are using gold IRAs as an accumulation vehicle, but not as a long-term storage solution. They're contributing to the IRA, getting the tax deduction, letting the gold appreciate tax-deferred, and then taking strategic distributions to move the metal into direct possession. They're paying the taxes, but they're eliminating the custodial risk and the regulatory uncertainty. They're converting paper gold into physical gold, and they're doing it in a way that maintains the tax advantages while reducing the systemic vulnerabilities. And timing matters here, because if gold does go to $4,000 or $5,000 an ounce, the tax bill on distributions gets proportionally larger. If you're taking a $50,000 RMD at $2,500 gold, that's 20 ounces. If you're taking the same $50,000 at $5,000 gold, that's 10 ounces. You're liquidating half as much metal to meet the same dollar requirement. So there's an argument for taking distributions earlier while gold is relatively cheaper to maximize the ounces you can move out of the IRA before the price runs higher. But that's a complex calculation that depends on your age, your tax bracket, your other income sources, your estate planning goals. There's no one-size-fits-all answer. What works for a 65-year-old with $200,000 in a gold IRA is completely different from what works for a 50-year-old with $2 million. The point is, you need to be thinking about these things now, not when you turn 73 and you're forced to start taking distributions. And you need to understand the market you're operating in, because gold isn't just going up on momentum. It's going up on fundamental demand that's not going away. Central banks aren't going to stop buying. They're diversifying away from dollars for strategic reasons that have nothing to do with short-term price movements. China isn't accumulating gold because they think it'll go up 10%. They're accumulating gold because they're preparing for a world where the dollar isn't the dominant reserve currency. That's the real story here. We're watching the slow-motion end of dollar hegemony. It's not going to happen overnight. It's not going to be a dramatic collapse, but it's happening. Trade is increasingly being settled in local currencies. Central banks are reducing dollar reserves. BRICS nations are exploring alternative payment systems. And gold is the one asset that every country, every central bank, every institution trusts as a store of value. So, when you're forced to take RMDs from your gold IRA, you're not just liquidating an investment. You're liquidating a monetary asset that's being accumulated by the most sophisticated players in the world. You're selling what central banks are buying. And you're doing it because a regulatory change that was passed in a 350-page bill that nobody read is forcing you to. That's the update. That's what's changed. And that's why if you have gold in an IRA, you need to be paying attention right now. The rules are different, the market is different, and the strategies that worked 5 years ago might not work going forward. You need to understand the new RMD requirements. You need to understand the beneficiary rules. You need to understand the tax implications. And you need to have a plan for how you're going to navigate this new regulatory environment while maintaining your precious metals exposure. Because here's the thing. Gold is doing exactly what it's supposed to do. It's preserving purchasing power. It's appreciating against devaluing currencies. It's acting as insurance against monetary instability. The problem isn't gold. The problem is a regulatory framework that's making it harder to hold gold in the most tax-advantaged accounts. And if you don't adapt to that new reality, you're going to end up paying more in taxes, liquidating at unfavorable times, and potentially missing out on what could be one of the most significant precious metals bull markets in history. So, take this seriously. Review your gold IRA. Understand the new rules. Talk to a qualified advisor who understands both precious metals and retirement account regulations. And make sure you've got a strategy that accounts for forced distributions, beneficiary planning, and the potential for significantly higher gold prices in the years ahead. Because the market isn't waiting, the regulations aren't waiting, and the wealth transfer from forced sellers to strategic buyers is happening right now, whether you're paying attention or not.